Hi, and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again here this week, where we're going to talk about our tactical portfolios, give you an update of what we're seeing in the market, what we're seeing in the portfolios, and how we're managing through what's going on out there. It's been a tough couple of weeks so far in June. We'll give you an update on kind of what we're seeing and also what we're seeing coming up. Keep in mind, everything we cover on here is for information purposes only. Do your own due diligence or reach out to us. You can reach us at mikeonmoney.com. Give us a call, fire us an email. Happy to answer any all your questions about your particular portfolio that you might have, or anything you're thinking about doing. We're always happy to help. So with that, let's jump into things. As we mentioned before, we're doing a slightly new format where we're going to be talking about on the tactical update. We're going to be talking about specifically our portfolios, our tactical portfolios, and how we're managing them in the markets and what we're seeing out there. So with that, let's talk a little bit about what's going on. Obviously, in June, it's been pretty tough out there. We've seen a lot of carnage over the last couple of weeks. There's really been no safe haven if you've been looking to find a place to hide. There's been a couple of small winners here and there, but not much going on. And we've even seen some of the commodities roll over a bit. And really what's the kind of the cause of all this, or the root of all this, has been inflation. We've been talking about inflation since last year, believe it or not. We're going into 6 months already of this year with inflation's been predominant. It's the overhanger of the markets that's driving up the interest rates. Obviously, we just saw the U.S. Fed do a 75 basis point hike. That's put a lot more pressure on the markets, especially on the commodity front. That's pushed them quite a bit lower over the last couple of weeks. Now, keep in mind, that's not necessarily a bad thing. I know you hear me say this quite a bit, that this is an opportunity. We're seeing buying opportunities a lot, and we did dip our toes in a little bit a couple of weeks ago. We've started adding to the dividend payers, the value players. So if you've looked in the portfolio, we've got BCE added in there. We've added a little bit more Algonquin Power. We've added to Alaris, Equity Partners. Anywhere we're seeing really strong dividends. We've also been playing a little bit in the debt area. We're seeing now debt portfolios paying around 7.5%, and they are down. If you look in the portfolios, they've also been affected during these markets, but that's nothing to be concerned about, because remember, the bond portfolios, yes, they've kind of gone very low volume, very low bid. So the overall price in your statements are coming down a little bit. But keep in mind, those portfolios have very strong yield to maturities. That's why they're paying that 7.5%, while still holding really strong quality in there. And we've been adding into this market, taking advantage of those high yields. Because if we can add more and more into the portfolio that's paying 6+% dividends or interest, we can wait through this market. And we're likely to see more volatility through the summer, especially with more rate hikes expected down the road. So not to be over concerned about it. We know June's, the portfolios have held in amazingly well through this year. Our pure equity portfolio seeing down about 6% into June here. We're seeing some of the markets off well north of 20%, 24, 25%, depending on which index you're looking at. So the portfolios are holding amazingly well, and we still have a really high cash percentage in the portfolio to take advantage of those downturns. But where are we seeing kind of the opportunities out there, or where are we seeing areas to take advantage of? We've talked about oil. We got into oil last fall. It's paid off amazingly well. I've also been talking for the last couple of weeks, I think now on to the fourth week, if you do have heavy oil positions in your portfolio, to start to lighten those, to start taking some trimming some profits out of there. Doesn't mean we're giving up on the story yet. We still like commodities, and oil in particular. There's still a bit of supply crunch, but that's starting to ease off a little bit. In fact, last week was a great example of that. We saw the oil price drop significantly. It's still not below $100 a barrel, but it dropped off a bit. It has bounced back up. but also we saw the outlook for oil, taking a bit of hit on that big 75 basis point hike in the US. And we saw the oil prices come off pretty substantially, so in some cases 10% or more. So, there is that kind of uncertainty. The bouncing back today, so not to be too worried. If you didn't, start to trim, you're going to have another opportunity. But keep in mind, where you are seeing wins in the portfolios, don't be shy to take some and raise a bit of cash, because we are probably going to retest our lows. We saw a couple of days of positivity in the markets after last week's big pullbacks, but that doesn't mean it's here to stay. We're probably going to retest that again, or at least get close, maybe even a little bit lower. It's really hard to tell at this point, but we will have opportunities to kind of buy into different areas of the markets that you might have missed on, or some of those big dividend payers are still pretty cheap out there. It's worthwhile easing into it. We are adding in, bits at a time, 0.5% here, 1% there, in the positions we like. We're not going all in yet. We are going to average our price into the market as we continue to see volatility through the summer. So what's our call? Well, recession is now the whisper out there. We've been talking about recession since January. I actually think we're in a recession. That's the problem with the recession. It takes 3 months of being in a negative growth to actually say, yes, you're in a recession. And basically, I think we're there. And when we hit that 3-month mark, we're going to be coming out of it. So that's the good news. Is I don't see this as being a really long recession. I don't see this as being a big impact on the portfolios. I see this as being a real opportunity to deploy that cash at great yields and taking advantage of things to come. We might even see, if we go into that full recession, as we come out of it in the fall, maybe into the new year, we might actually see some rate cuts coming down the pipeline. Small ones, maybe a quarter basis points, but still it will signal to the market that the Fed was a little over aggressive. Really what we've likely seen, and it's hard to tell, hindsight's always going to be 2020, but likely what's happened is the central banks of the world took too long to start raising rates. They wanted to wait till 2023. They realized that was impossible. They waited and waited, and then they've gone aggressive to try to head off this inflationary monster really hard, really fast, which is good, but they've probably gone too aggressive too fast, and they'll have to reverse that a little bit. That's not a bad thing. It will put us in a good position for a good fall and into 2023. So really, that's what we're seeing, as the opportunities in the markets. It's going to be a bumpy summer. The key word I'm going to give you is patience. Don't worry too much about what you're seeing out there. There's real opportunities. If you have cash to deploy, take advantage of that. These are buying opportunities for sure. Again, I'd be patient as you step into those waters. Be very targeted. It's kind of sniper approach out there. Pick up the really strong names. As I said, we're focusing on cash flow. Really looking for the strong quality returns. But that being said, we are starting to look at growth opportunities as well. A little bit more torque in the portfolios for the fall and going into the new year. But we'll hear more about that in the coming weeks. We're definitely not at that point yet. As I said, we're probably going to retest the lows of the markets, or maybe make some new lows. It's impossible to pick up the bottom, but definitely looking for some more value still into the market. So with that, thank you very much. As always, reach out to us at michaelmoney.com if you have any questions whatsoever on the portfolios. And we look forward to bringing you more of these updates every 2 weeks. We're going to try to get them out to you. And love to hear any comments or feedback. With that, thank you very much. As always, take care of yourself.